County Executive for the purposes of public health and safety. The City Council is meeting remotely under Section 610.015 of the revised statutes of Missouri. City Council members who are not physically present in the council chambers can participate and vote on all matters when an emergency exists and the nature of the emergency is stated in the minutes. So again, we'd ask the minutes to reflect that we are still, unfortunately, in this COVID-19 pandemic, and that's why we're meeting remotely.
Great, thank you. So first order of our business is approval of our November 5th, 2020 work session minutes. Is there a motion to approve?
Of approval.
Is there a second?
Second.
All right, any questions or comments? All right, seeing none, all in favor, please say aye.
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 All opposed, say no. Motion passes. First item of business is a report on the city's deferred compensation plan. Russ, would you like Georgia to introduce that?
Yeah, let's have Georgia introduce Brian. I see that he has come on now,
Oh, okay.
so let's have Georgia handle it from here.
Great, thank you.
Sure, no problem. Before we get into Brian's presentation, and Brian, by the way, has worked with the city and our pension plan since the late 1980s. So he is very, very familiar with our retirement plans. I do have a little bit of information that I got from the TIAA website. And I wanted to make clear that we have really great participation in our deferred comp plan. We actually have 281 active contributing participants. And so that is really almost everybody. And that is because at every January, as part of our plan rules, we enroll everyone who is not part of the plan. And then they have the ability to come and tell us they don't want to be a participant. But what we want to make sure is that inertia is on our side, that we try and make sure that people are saving. And so we have, like I said, great participation. So I will go ahead and let Brian, go through his presentation this evening. He probably wants the ability to share screens. So whoever's the moderator for the session, can you make sure and allow him to have that access, please?
Okay, thank you, Georgia. I just want to say that I'm not as old as you might think, since I've been working with the fund since the 80s, because I was only 10 years old when I started. So I do have a presentation that I want to go through. So I'm gonna share my screen, and we did send this out in advance. I've got I have the file, and you should see a cover page now. Now I can tell you this: as of today, we did update the market environment for this report with our October information. So I can either go through this just as it stands, or I can revert to the new market environment to kind of give you an update on where things are as we sit today. I don't want to do that though with your permission, because
No, I think that would be a good thing, Brian. Why don't you go ahead and do that?
okay, I'm going to stop sharing for a second, and I'm going to pull up a different file then. So this is our October market environment, and I have just breezed through it very briefly. So you'll excuse me if I'm not quite as familiar with everything in here as I normally would be, but I'll just kind of give you an update, a quick update on where we stand as of the end of October. I think the first few points are very familiar to everybody. Joe Biden has been declared the winner. President Trump is still refusing to concede, at least the last I saw. And it looks like the probability is that Congress will be split, with the Republicans remaining in control of the Senate. Of course, it depends on the runoff election in Georgia, but all the pundits seem to think that the Republicans will control the Senate with one extra seat. And of course, the Dems have they're going to maintain their control over the House of Representatives. Markets have surged. I'm sure you've seen markets are up drastically over the last few days since the election. I think it indicates that there's a certain feeling among investors that they like the fact that we're going to have a split government. We're going to have a president that might be a little bit more calming to the nation, but with the split Congress, it doesn't look like there's going to be a whole lot of changes that may take place legislatively. Coronavirus cases are on the rise. That is a concern. We've got good news on the medical front as far as vaccine development, but we are seeing cases going up at some pretty alarming rates around the country. Some of the good news that we have in the market is unemployment. October unemployment came in, dropped to 6.9%. The expectation was 7.7%. So that's a really strong number. We had 638,000 jobs in October, and that's certainly a positive for the economy. We're not back to where we were pre-pandemic, but we've made a lot of strides to make up for some of the job losses that we had in the first quarter. And GDP came in very strong too, up 33.1%, also higher than analysts expected. And that's after a negative 31.4% GDP drop during the second quarter. And of course, because of the mathematics of starting from a lower base, when you look at this gain, GDP isn't back to where it was pre-pandemic levels either, even though they're very similar numbers, because you're starting from a lower base. Here's a look at the Senate and the way it's panning out. It looks like Georgia here is in purple. We don't know the outcome, but the likelihood it's going to split with one Republican and one Democratic senator, and that's where we come up with the Republicans remaining control of the Senate. And then this is a look at the country with the House: 218 Democrats, 201 Republicans, and you can kind of see what parts of the country those seats are coming from. We're seeing most of the states have reopened, but a number of states have paused or are reversing. States that are reversing their reopening plans are in orange here, and those pausing are in this light tan color. And then here's just a look at what the equity markets have done. You can see the S&P 500 in light blue, NASDAQ, which is very tech heavy, in the light green, and the Russell 2000, which is, excuse me, is a small cap index in the dark line, the black line. We thought this chart was interesting, and that's why we included it. If you go across here and look at the totals, even if a vaccine were approved by the government, this particular survey points out that about 22% of the population said absolutely they would not take it. And the about 44% of the population said that they absolutely would take it. So aside from the problems of getting the vaccine distributed, there will be some reticence among certain parts of the population in taking the vaccine. So it'll be interesting to see how that pans out. These positive numbers probably will go up as it's introduced. On the fixed income side, fixed income has been positive all year. The returns haven't changed all that much. We had a very strong first quarter because rates dropped. Treasuries in particular came down and had big gains. So we show a one-year return of 6.2%. As of this morning, the aggregate index was up about 6.25%. So very close to that year-to-date return that we had at the end of October. You can see that the credit markets have largely repaired. One thing that I want to point out, and you may notice it when we go through the managers, Treasuries was really the place to be as markets sold off in the first quarter. So most active managers were light on Treasuries. The aggregate index has about 40% Treasuries in it, And most managers had a lesser amount in their portfolios. They're much more heavily on credit. Credit sold off a lot more. So the first quarter returns were terrible for active managers. Most active managers underperformed. As the markets have come back and spreads have narrowed and credits have performed better, those managers are doing well, but a lot of them haven't made up for all the losses in the first quarter yet. They will eventually, assuming that we don't have a big rise in defaults, because those positions will come back and they will get back to outperforming. Many of them are outperforming year to date now, but not all of them. So you can see the repair we've had. We had a lot of negatives here in the credit markets, and they're pretty much all positive except for bank loans right here at negative 0.7 year to date. I'm not going to go over this. I really haven't had time to study this because I say this just came out today, but this is just our research department's take on various aspects of the bond market and some takeaways here. Consumer is in good shape. You'll notice on the right-hand side here that these tails are all coming down. These are mortgage and home equity loan delinquencies. Also credit cards, auto loans, and student loans. You see this, the student loans in light blue up here have the highest delinquency rates, but they came down drastically. A lot of it probably had to do with the PPP program and the fact that they stopped charging interest and stopped requiring payments during this period. So that helped a lot of younger people with college loans. But as you look here, you see credit cards have come down a little bit. They really didn't rise a whole lot in this whole thing. Auto loans are still in good shape and have actually dropped a little bit. And mortgages remained low throughout the whole first quarter in the drop, as well as the home equity lines of credit, the HELOCs. So the consumer is still in pretty good shape. Another good sign is that downgrades really leveled off. We did have a little bit of a spike in this third week in October, but we've really seen downgrades come back down, and just another indication that the credit markets have largely repaired themselves. U.S. equities, this has been a roller coaster. In the last 6 weeks or so in client meetings, I reported everything for the S&P 500 from year-to-date performance, someplace around this 2.8%, probably I think 2.4% was the lowest. As of the end of the second quarter, the S&P was still negative 3.3. It got up as high as about 10.5. And as we sit today, the market's up 12.44% year to date. And that is simply incredible when you think of the market being down about 35% in March, bottomed on March 23rd. We've come all the way back. We were coming off a year where the market was up over 30%. And I think anybody would take a scenario, in spite of all the volatility, that we had a 30% plus year return last year and a 12.44% year to date this year. We'll see if it holds. The other things you see, all this for 10 years, I've been reporting that growth has been outperforming value. All of a sudden, this past month, we're seeing value start to outperform growth. So that's been good to see. And small cap stocks are starting to perform better too. Large cap has been trouncing smaller companies as well. One concern we have had with the market is the 5 largest stocks in the S&P 500. Keep in mind that the S&P 500 is a cap-weighted index. So the larger the company, the bigger of an influence it has over the index and the larger weighting that company has in the index. These 5 stocks, Facebook, Amazon, Apple, Microsoft, and Google, they at one point accounted for about 24% of the weighting of the index. So just a heavy concentration as far as the index. And you can see at one point in time, they were up over 60%. They have sold off a little bit, came back and sold off again. So year to date, those 5 stocks are up about 39.1%. However, the S&P, as of the end of October, was only up 2.7. The other 495 stocks in the index were actually negative 4.6%. this is an extremely narrow market and not really healthy for the market. So we'd like to see these numbers come in, hopefully by having these other sectors and other stocks in the market go up, and not necessarily by having these come down so much. But the last time we had anything like this, and it wasn't as big of a weighting, was during the dot-com bubble. And then just another indication, as you see that the top 10 largest stocks make up about 44% of the growth index and only about 15 to 20% of the value index. So that's another reason why growth has outperformed for so long. Now we're seeing value pick up. It's interesting here, as you look at the dark lines here, highly profitable stocks have outperformed in the S&P 500, the large cap markets. That's what you would expect, and that's what happened. In the small cap market, however, the most profitable companies actually had negative returns, and the companies with the lowest profits, in some cases negative, were actually positive for that period. So it was a complete reversal of what you would normally see in the markets. And then, as I mentioned, we haven't seen the kind of disparity in growth versus value since the tech bubble. This is where it was. This light gray line is one standard deviation. So we reached a pretty big peak here during the dot-com bubble back in the late 90s. We're way above that now. And, you know, it really shows up, and you'll see it when we go through the report, the difference in performance between your growth managers and your value managers. It is striking how different they are. And then just to give you an idea of what to expect, September typically is the worst month for the market. You can see these are the percentage of times the market's positive. It's the only month where it's actually been negative more than it's been positive. It's only been positive 40%, 47% of the time. You've heard of the Santa Claus rally. Well, this is it. 74% of the time, December is positive. So hopefully, you know, and 62% for November. So hopefully the end of the year will remain positive for the markets. I'll go over the non-US equities really quick because it's very similar to the US. We also saw a big snapback after a big drawdown in the first quarter. We saw some pressure the last couple of months, just like in the US. We saw some negative pressure on the markets up until just the last few days since the election. You'll notice here that the year-to-date returns have not recovered the way they have in the US. Remember, the US was up over 12%. Actually, only as of the end of October, up only about 2%, but now up about 12.5%. You still see a lot of negative numbers in international markets. You see the 1, 3, 5, 10-year returns, very anemic compared to US markets. And we've been saying this for the last 10, 12 years since the financial crisis. And also we're seeing volatility go up, not only here in the US, but across the globe. Volatility in the markets really bottomed in 2017. This is the number of days that the markets move 1% or more in any single day. You can see they peaked during the financial crisis, came way back down, bottomed in 17, and now they're marching back up. And we're looking at figures here that would probably pretty much be in line with what we saw in the financial crisis, because this is a year-to-date number, assuming volatility continues. And then by sector, not much different than what we see here in the US. I didn't go over it, but it's very similar. The growth sectors of the market, communication services and information technology, healthcare, had pretty positive returns. The more value-oriented areas of the market, energy, financials, real estate, industrials, negative returns year to date. And then by country around the world, China, Taiwan, Korea, US, all positive. Last month, Switzerland was also positive, but it's sold off. You can see the pain we've had in Europe with Spain, UK, Italy, France, Germany, all down considerably. And Brazil has got a whole host of problems. Not only is the pandemic a big problem down there, but they have problems with their economy and big problems politically as well. And then we're also seeing some big concentrations in the emerging markets index. This is just to look at the returns of the top 5 contributors in the emerging markets versus the rest of the market. Very similar to what we're seeing here in the US. And looking at long cycles, just as growth has outperformed value for a very long cycle, We see the same thing in international markets. The reason we think it's good to still have international portfolios is because these do reverse. When this blue area chart is above the black line, the US is outperforming. When it's below the black line, non-US is outperforming, or international stocks. We've been in an extremely long period of US outperformance. Eventually we'll get back here, and that's why it's good to have both in a portfolio. We don't really have anything in hedge funds, so I'll skip that. We do have money in the public real estate markets. The NAREIT index, because we have public REITs, is really the index we're looking at. REITs have not done very well so far this year, down year to date about 12.3%. Much more volatility than the private real estate market, which is represented up here, because these markets just take their value from the underlying value of the properties and the income they generate. The public markets trade on the US exchange, so heavily influenced by the volatility in the public markets, in the equity markets. We're still seeing some big negative numbers here for REITs. Breaking it down, I think this is interesting, not surprising though. Hotels, retail have been the worst performers. Industrial, which includes warehouses, with e-commerce as a big part of it, very positive returns in the real estate market. So concentration, the sector exposure is very important. And then there's some real estate takeaways. And I'm going to stop sharing this because that's really all I have on the economy. I've got more information, but none of it really applies to this fund. And then I'm going to go back to the original report. Can everybody see the cover page here? All right. I always skip the Marquette update. That's just an update on things that are happening with our firm. I don't have any reason to go over that. We did hire somebody here in St. Louis. So that is a good thing. We've added a person here on our office in St. Louis. I ran my own firm for a number of years and merged with a company out of Chicago. So I run the St. Louis office, and we did just add a person locally. So here's a look at the fund. We've got everything is with TIAA, which is Teachers Insurance and Annuity Association. Very large and well-regarded provider. You can see we have all of the managers that we have available to the participants listed here, next to the asset class that they're managing. And then we've got a status which is in compliance. We have one manager on alert due to performance. That's Glenn Mead. They're not the only manager that is underperforming, but they're the ones that concern us the most, and who we think should be outperforming in this environment. Everybody else is in compliance and doing well. So total assets in the deferred comp plan of just under $23 million in assets. I'll blow this up a little bit to try and make it easier to see. So just under 23 million of participant assets in the plan. I gotta try and move that again. The participants guide their own allocation in how they invest these assets. So this is a summary of all the assets in the fund, but it's really a result of all the individual investment decisions made by the participants. You have about $3.4 million in the stable value fund, and that comprises about 15% of the assets. Your total fixed income exposure is only about 10%, and stable value can be considered fixed income too. So altogether, you have about 25% in fixed income type investments, 8.2 in the bond market index fund, and only 1.7 in the actively managed fund. Equities comprise about 42% of the total portfolio, and you can see how that's divided up. A lot of money in Columbia large cap, Vanguard US growth, and the Vanguard small cap index fund, as well as the Wellington fund. And then non-US equities comprise only about just under 6.8% of the assets. Real estate, a very small amount, 0.8, and then a little bit in cash of about 0.9%. The target date funds are your second largest allocation in this particular fund. I went too far. It's kind of interesting because in your employees' pension fund, this number is much higher. In the employees' retirement fund, we have close to half of the employees have their money in the target date funds. In this deferred comp plan, only about a quarter of them have money in this plan. And you can see how it's allocated. The big areas are in the 2025 and 2035 funds, but you've got money spread out among all the funds. So looking at performance, we have this report divided a couple of ways. And once again, remember, we're looking at September numbers. Even though I went over the October market environment, we're only looking at September performance. So there's going to be a little bit of a disconnect there. But you can see the stable value fund has given you very low single-digit returns, which is pretty common for stable value. Both the bond market index fund, which is really returned about the same as the index, which is all we expect from them, has performed for the longer periods in the top half of funds. That actively managed fund, which has very light participation, has actually outperformed over time and is performing better. So it's interesting that most of the employees are in the index fund. I would, if I was an individual, I would prefer to have my money in this actively managed fund, just because of the fact that active managers do a pretty good job in the fixed income market of picking which sectors to overweight and underweight. Even though it didn't work the first quarter, over time it's worked pretty well. The U.S. equities, and you'll see composite numbers. We don't run composites here because, as I say, all of the individual employees all have different allocations, so there's no point in running a composite. The Dodge and Cox stock fund is an active managed fund. Its benchmark is a Russell 1000 value, and you can see Dodge and Cox has underperformed over the last couple of years. And I'll just try and move this up a little bit so you can see the period. So we got 2 years here. They've outperformed in the 1 year and year-to-date periods, but they're pretty much performing as we'd expect. We don't mind a little bit of underperformance here and there because they are a value manager. They're very strongly value-oriented managers, so they will tend to perform worse in the value market when the value market's down, and they tend to perform better when the value market's up. You've got an index fund here matching the index. You can see that is mostly top half ranking versus active managers. Glen Mead is a large cap growth manager. They're the manager we have on watch. We're not happy with their performance. They should be performing much better in this market. Even though they're a growth manager, though, they do have some value metrics that they manage by, and they just don't have the concentration in those very large positions that I showed you on the market environment. So that's why they're underperforming. But when a style outperforms, we'd like to see the managers that are managing that style outperform. We have your growth. We have growth index fund as well, so that the participants do have a choice to be passive with this particular allocation as well. And you can see how well the index has done compared to active managers. These percentile rankings are in the top 10%. One's the best, 100 is the worst. So the index has outperformed 93% of the active managers in the universe over the last couple of years. AllianceBernstein, another value manager in mid cap, is also underperforming. We do have some concerns here, but not great concerns because once again, they're a value manager. If they underperform when the value outperforms, then we'll definitely be more concerned about what they're doing. We have a Vanguard Mid-Cap Index Fund, which has matched the index. Also, the index funds have trounced most active managers, as you can see by these high rankings. And then we have a growth fund. And in this case, the American Century Heritage Fund is outperforming the index and is ranked high for this year. So this fund is performing exactly like we'd like to see it perform. On the next page, we have the non-US managers. We have DFA, also a value fund. Their performance is pretty close to the index. They're ranked pretty much around the middle of the universe, and pretty much in line. DFA always tends to be pretty value oriented and also has a tendency to be a little smaller than the markets that they manage in. So we're not surprised by this performance either. We have an index fund available to the participants. Once again, matching the index, ranked very high. Treehouse is a new manager that we just hired a short time ago to replace an underperforming manager. They're off to a great start, as you can see here. Very big returns versus the index and very high rankings. And then Wellington is more of a balanced manager. They've done okay over time. Their numbers were actually better before, but they're doing okay relative to the index. The 2-year number, 23rd percentile, even though they're under the index. And then on the foreign side, we have a variety of managers here as well. We have Templeton Foreign, which is, I think everybody's heard of Templeton. They are an international value manager, outperforming a little bit in the year-to-date and 1-year period, underperforming so far 2 years, but pretty low rankings. Once again, value-oriented, not surprising that they extremely value-oriented firm, not surprising that they'd be underperforming. And then this money is all indexed in the International Stock Index Fund. You can see that, once again, pretty high rankings compared to the index for the developed world, the developed markets, and then the Emerging Markets Fund, pretty well matching the index and right around the median, or a little bit below the median. And then last but not least, we have real estate. This is the REIT fund, underperforming for 2 years, outperforming a little bit for 1 year, but pretty low rankings compared to the benchmark. Pretty benchmark centric though, very close for these time periods. And then cash is giving you not much in the way of returns. So it's a pretty diversified lineup for the participants. Just for, oh, I almost forgot the target date funds, where you have about a quarter of the assets in here. Target date funds under TIA have mostly done very well. You can see we have the life cycle index retirement income fund. This is where all the money ends up dropping eventually as people get beyond their retirement. TIA is still carrying their 2010 and 2015 targeted funds because they feel that people, even after they retire, they still have an investment horizon. So they keep these funds and they continue to get more and more conservative as the funds age. And eventually, as I say, they'll get to the same allocation as the retirement fund, and this money will be moved into that retirement fund. As you go down the list and go from the shorter dated funds to the longer dated funds, you can see 2015, very conservative, has very low rankings, but everything 2020 and over, very high rankings and very good numbers compared to the benchmark. And these are apples to apples benchmarks. These are the Morningstar lifetime, 2030, 2035, 2040 indexes to match the particular date of each target. And I believe TIA actually has a 2065 fund that they've come out with, but we don't have any money in it yet. We have individual years here. So as these investments age with TIA over time, you can look back and see where the cumulative performance came from. And then we have, as we go back here, not quite there yet. We have all of this information completed, but repeated, excuse me. But instead of just having the time period that you've actually been invested with TIAA, we went back and included historical numbers to go back 10 years. So you can look at these funds all over the long term to see how they fared over the long term compared to their benchmark. Once again, for the sake of time, I'm not going to go over that, but it's there for your information if you so desire. And then we have a page here on just risk statistics. And once again, for the sake of time, I'm not going to go over this, but everything looks pretty good. I really concentrate on alphas and Sharpe ratios and that kind of thing. That 2015 has a large negative alpha, because the underperformance I showed you being so conservative, but everything else is fairly positive. Let's see. Oh, here it is. The first page. Where am I? Here's the first page. Here are the fixed income and equity managers. Glenn Mead also has a very big negative on the alpha, as well as Alliance Bernstein and Wellington. So very diverse lineup. It's not unusual to see some funds underperforming with other funds outperforming. It wouldn't be a diversified lineup if you didn't see that. And then once again, for the sake of time, I'm not going to go over all of these, but we do have pages for each one of the composites. Here's the fixed income composite, as well as each one of the individual managers. And it just goes over a lot of statistics about the portfolio. So your fixed income characteristics, yield to maturity, duration, and all that kind of stuff, sector exposure, maturity schedule, regional exposure, and quality distribution of the assets for fixed income. And then we have the information for each one of the individual managers as well. Once again, I'm not going to go over all this with you now. And then for equities, we have the same type of information, but it's geared toward the equity managers. Here's the equity composite. You can see we have a style chart, or risk return chart up here with return and risk plotted out here, so you can see how much risk and return each one of these managers is getting. Higher up on the page, the better. More to the left of the page, the better. Characteristics for each one of the funds, largest holdings, top contributors, bottom contributors for the quarter, sector exposures, and capitalization exposures. So that's available for each one of the funds that are available for investment by the participants. And that goes all the way down to the last thing. The last thing I want to show you in this. This is very important. A couple of pages listing all the funds. We list the expense ratio that for each fund. We list the annual fee in dollar terms, and this is based on the asset value as of September 30th, the date of the report. This is not a 12-month look back. This is the fee calculated based on asset values. So it's our best estimate of what you're paying annually in fees. We compare the percentages to the industry median, and then we, for each one of the funds, and these are apples to apples comparison, and then we total it all at the bottom on the total assets in the fund. You're paying about $55,500 in fees, or about 0.24%. We also express that as 24 basis points, and that compares very favorably to the industry median of about 74 basis points, or 70%. So very low fee structure, and that's certainly important consideration. And then last but not least, I do have an update. Same first page. This is just through October, and this is just a quick look through October. Once again, you can see how the assets are allocated through October, and then you can see returns versus benchmark for October. We don't have any rankings, once again, or any information on any composites, but you can go through and get an idea of how the funds did through the most recent period. So once again, for the sake of time, it's only 1 month difference, so I'm not going to go over with it unless there's anybody you'd like to take a look at. And then we have the same historical performance pages to take you back longer than the period of time that these funds have been available in this particular plan. And the same fee information. And that's it for what I prepared for the report. I'd be happy to take any questions.
Thank you, Brian. For sake of time, Georgia or Russ, is there any action that council needs to take tonight, or is this really just more informational for us?
No action is necessary tonight. This is informational only.
Okay, thank you very much. We do have a closed session. Are there any brief council questions for Brian?
I'd have a couple of three, Tim.
All right, Councilmember Ward, Wallace.
Yeah, one of the things that was discussed today at the Chamber Economic Outlook meeting was the issue of concern about inflation because of the large cash dump that the federal government's making
Hey, Wallace, can I interrupt you for a second? Brian, could you get rid of your screen share?
Oh, I'm sorry. Sure,
no.
absolutely. Apologize.
Thank you. All right, go ahead, Wallace.
yeah, you can see my picture really looks good there. So I'm wondering, one, how you would your funds are going to plan for and adjust for that upcoming inflation. I know the Federal Reserve guys have been talking about that sometime, trying to keep the economy from overheating. And then also compounding that is we can expect at some point the foreclosures and evictions that have been held up by the Fed are going to come, and those should impact the markets in a big way. Then the inflation due to the foreign markets reacting to all this too. So.
Yeah, we've been thinking for quite some time, and it goes all the way back. The Fed really expanded its balance sheet and printed a lot of money during the financial crisis, and there was talk then that this would lead to inflation, and it didn't happen. We didn't have it in this set of slides, but in the past we've had a chart showing both the growth of the federal deficit as well as the growth in the Fed's balance sheet. It peaked sometime after the financial crisis, and it was actually started to come down as the Fed started tapering. And then you see a big run up this year with all the stimulus that they supplied during this pandemic. So I think everybody is aware that the Fed has come out and said that they expect to keep rates low for an extended period of time. They are willing to let inflation run up above its target for some period of time. That their target has been 2 to 2.5%. They expect to let it run up maybe north of there, maybe 3.5%, something like that, to make up for some of this period of time where we've had less inflation than the target, in order to try and reflate the economy. The problem is, though, there's still a lot of slack in the economy, and it's going to take, I don't know what it's going to take to make inflation rear its ugly head. I think the Fed has been trying to push that one way to help mitigate the deficits when you have high inflation. So I'm not really giving you an answer on how we're preparing for it, because we're not sure when it's going to come or if it's going to come. I think you're right. I think eventually it will happen, but I don't know that there's any particular way to prepare a portfolio for that. From an asset allocation basis in an inflationary environment, you probably don't want to have much exposure to fixed income, because you're going to see interest rates climb in that kind of an environment, and bond values are going to go down. So you're going to have a double whammy of having higher costs and lower values from your bond portfolio. Equities have been a decent hedge against inflation. Certainly real estate and those kind of things, it's good to diversify portfolios in those ways. But I don't know, other than changing the exposures in your portfolio, and other than knowing beforehand when it's going to happen, I'm not sure how you can prepare for an inflationary environment like that. I think we're going to see it, but it may be further off than people think.
Thank you.
All right. Anything else from council? Bob, you have your hand up? You're muted. There you go.
Okay, my question is just to see if I could extract from you kind of a nutshell. You know, what are the positives, negatives, anything we need to be concerned about that among the numbers we just saw, or things we should be positive about?
Oh, I think you should be positive. As I mentioned, if you're talking about this plan and the structure of the plan, I think you've got a great service provider in TIAA. They're low cost. They do a great job on education. So I think you have a really good program for the participants. I think your investment lineup is good because it's diversified. The participants have a lot of choices for both active and passive investments. As I say, it seems counterintuitive, but a healthy plan will have disparity in returns because you'll have certain funds, given the current environment, like the value funds that aren't doing well, and certain funds like the growth funds that are doing well. We do have Glenn Mead, your large cap growth manager, on alert, and we're looking at that very closely. If we make the decision to terminate him, I will talk to Georgia and ask to get an audience with you to give you a choice of managers that we might replace him with, but we're not there yet. And I'd kind of like to see how this plays out before we replace him, because sometimes you replace a manager and it tends to be at the wrong time, just as they're bottoming. You move the assets to somebody that's doing really well, and all of a sudden their performance falls off as the manager you just replaced picks up. So we don't want to get in that whipsaw kind of environment. So if we see the market broaden out, if we see value start to pick up, if Glenn Mead doesn't start to perform better, and I say that even though they're a growth manager, they do have some value parameters that they work with. All managers do. So if they don't perform better as these markets change, then I will come back to you and suggest we replace them.
All right. Anything else from council? All right. Seeing none. Well, Brian, thank you very much for your presentation and for that information. Georgia, thank you I know the two of you work together mainly on this. We appreciate all you do with that. Russ, anything from you before we close out?
No, we appreciate
Okay.
Brian coming in and explaining the performance of all the funds there. So that's very helpful to us.
Yeah. Thank you. Thank you very much, Brian. Always good to see you.
Great, thank you. Very
Thanks,
good.
Brian.
Uh-huh.
Appreciate your
All
time.
right. Now we're going to go into closed session for legal matters. So is there a motion to go into closed session?
So moved.
Motion.
All right, we got a motion and a second. Questions or comments? Roll call, please.
Mayor Griffin,
Yes.
Councilmember Ward,
Yes.
Councilmember Wirtz,
Yes.
Councilmember Gibbons is absent, Councilmember Sears,
Yes.
Councilmember Dewey, Councilmember Dewey,
Yeah.
Yes.
Okay.
Sorry.
That's okay. Councilmember Zimmer,
Yes.
All right, that's everybody. All right, we are now closed. So if I'd ask everyone to leave this meeting and immediately go to the Zoom for the close.